These are the early signs of a global liquidity crisis, which is different than a recession and different than called a plain vanilla, financial crisis. The liquidity crisis, is when you get ready to turn up the lights. There's a dollar shortage around the world, and people say, how can that be? The Fed printed, $7 trillion of money, M0, actually higher than that. I think it went up to 9 trillion. They just flooded the zone with money. And the answer is yes and no. Yes, they did print, over $7 trillion of base money, so-called M0. But that money didn't go anywhere. How does the Fed print money? Well, they buy bonds from dealers, from the big banks, the so-called primary dealers. So the open market desk at the Federal Reserve Bank of New York calls up Goldman Sachs. They offer me 10-year notes. Goldman says, here's a price. Okay, done. Goldman delivers the notes to the to the Fed, and the Fed pays Goldman. And that money comes out of thin air. That is money printing. But then Goldman takes the money and gives it back to the Fed as excess reserves. It doesn't go into the real economy. Nobody borrows it, nobody spends it, nobody lends it. All that happens is at the Fed, you're building up both sides of the balance sheet. You're building up the asset side with U.S. Treasury securities, and you're building up the liability side with deposits from the primary dealers in the form of excess reserves. So that money doesn't do anything. I mean, it's printed, if you want to say that, but it has not caused inflation. The inflation comes from, as I discussed earlier, from the supply side, the price of oil, supply chain disruptions, wheat, food, gasoline, et cetera. The inflation is flooding in, and it's exacerbated by fiscal policy. Now, you have to, what I just described about the money printing, that's monetary policy. Okay. But fiscal policy, which is the 5 or 6 or probably $7 trillion of deficit spending, that's helicopter money. When the federal government and the Congress and the Treasury hand out checks, that's helicopter money. That's not like giving Goldman money and then Goldman gives it back to you. Forget that. It doesn't do anything. I mean, it exists. It doesn't do anything. But when the government hands out checks, that's real. Now, some people saved them during the pandemic. A lot of millennials opened accounts on Robinhood and started trading cryptos. They could, kiss that money goodbye. But more recently, that money has been spent, and that's when the inflation really took off. So that was driven not by monetary policy; it was driven by fiscal policy. But getting back to the strong dollar, there's something else going on, which is the entire international monetary system is driven not by the Fed, but by Eurodollars, by money that banks lend to each other so that they can support their balance sheets and lend to customers or offer transactions to customers if they will. And the main transactions is approximately $1 quadrillion of derivatives, options, futures, forwards, swaps, swaptions, I could go on and on. All of that, almost all of it, has to be backed up by collateral. I could say, if I'm a hedge fund and you're Morgan Stanley and I call you up and say, Addison, I want a $5 billion total return equity swap, which is basically a derivative basket of stocks, and I can buy and sell stocks all day long up to 5 billion, but it'll be notional. You'll pay me the profit or loss and dividends, but I don't actually own the stocks. I just have a $5 billion swap with you. And then you go out and maybe buy the stocks and hedge your position. You'll do that for me if I'm a big enough hedge fund or sovereign wealth fund or institution or whatever, but you want collateral. I don't have to give you $5 billion worth of collateral. I just have to give you enough, a little bit of foundation and the mark-to-market losses. So if I lose money on that deal, I will give you that much collateral. So collateral is the key to the whole quadrillion-dollar structure I described. So what's good collateral? Well, it used to be a lot of things, but today banks are saying to each other, we don't want your corporates, we don't want your stupid mortgages. We want, 2-year treasury notes, maybe with a haircut, or 6-month bills, 4-week bills, 30-day bills, the best, absolute best, most liquid form of collateral. Well, okay. First of all, there's a scarcity of that. There's a collateral shortage, and banks desperate to prop up their balance sheets are asking, we're going to get some treasury bills. And they're bidding for them at prices that produce yields to maturity lower than what the Fed will give you for free. So if I'm a bank and I can call the Fed and the Fed will give me some treasury bills and I give them cash under an agreement to unwind that, and the interest rate on the cash is whatever, why would I go out in the market and bid on a treasury bill that pays me less than what the Fed will give me for a phone call? Why would you do that? The answer is you need the bill. In other words, you don't need an expanded balance sheet. You don't need more credit at the Fed. You need that bill to pledge as collateral on this $250 of derivatives. And that's what's happening. So how do I get a bill if I'm Deutsche Bank or Credit Suisse or UBS or Unicredit or Barclays or anybody else? I need dollars. Because the bills are denominated in dollars. So if I want to buy them, I got to get some dollars. So there's this huge bid for dollars that can be used to buy the treasury securities, to pledge as collateral, to prop up the balance sheet. And that's what's going on behind the curtain. That's the plumbing. That's why the dollar is strong, even though everything about the U.S. economy is weak, meaning recession, long-term depression, deficits, trade deficits, political dysfunction, borderline civil war. It's all bad. But if I'm Deutsche Bank, I need those dollars to buy treasury bills to prop up my balance sheet.